everyone, and welcome back to Mortgage Breakdown. If you're a first-time buyer, mortgages can feel like a giant puzzle. Don't worry. In this video, I'm going to walk you through the key steps every first-time buyer needs to know about mortgages. By the end, you'll understand the process, what lenders look for, and how to set yourself up for success. The first step is to understand what a mortgage really is. A mortgage is simply a loan you use to buy a home. In August 2025, the median sales price of a home in the U.S. was just under $440,000. Since most of us don't have that kind of cash laying around, lenders step in and cover the cost of the home, and you pay them back in monthly installments, typically stretched out over 15 to 30 years. This monthly payment is what most people think of when they think about a mortgage: principal and interest. However, your payment to your lender isn't just principal and interest. It usually includes 4 parts: principal, interest, taxes, and insurance, known as PITI. Knowing how these components work together is the foundation for all your mortgage decisions. We'll circle back to why that matters in a minute. Step 2 is to figure out your down payment. As a first-time buyer, the down payment is usually your biggest hurdle. Traditionally, people think you need to have 20% of the home's price saved up in order to buy it. On a $300,000 home, that would be $60,000, a number that stops a lot of people in their tracks. Here's the good news. Many loan programs allow much less. FHA requires just 3.5% down. That's $10,500 on a $300,000 home. Conventional loans can start at 3 to 5%. There are also USDA and VA loans that allow 0 down if you qualify. On top of that, down payment assistance programs exist to help you cover that cost and make up any difference between what you have saved and what you need. In short, not having a huge lump of cash saved up is not necessarily a deal breaker. But here's the trade-off. The smaller your down payment, the bigger your loan balance, and the more interest you'll pay over time. So it's about balance, or asking yourself how much cash you can put down without draining your savings. Step 3 is to check and improve your credit score. Your credit score is a huge factor in whether you qualify for a mortgage and what your payments will look like. FHA is forgiving. Many lenders allow scores as low as 580. Conventional home loans typically require at least a 620, and the very best rates go to those with scores in the 700s. Here's the impact. If your score is 620, your interest rate might be a full percentage point higher than someone with a 740. On a $250,000 loan, that's an extra $150 to $200 a month. Over 30 years, that adds up to tens of thousands of dollars. So your step here is to know your score, fix errors, and raise it if possible before you apply. One more thing that trips up a lot of first-time homebuyers: avoid making big changes to your credit right before you apply. Don't open new credit cards, finance a car, or run up large balances. Every new account creates a hard credit inquiry, which can lower your score temporarily. It also changes your debt-to-income ratio, which lenders watch closely. Even if you're offered a great store credit card deal or a buy now, pay later option, hold off until after you close on your home. There's no point in opening up a Home Depot store card if that's what's going to keep you from actually buying your home. Stability is key. Lenders want to see consistent, responsible credit use, not sudden changes. Step 4 is to understand what goes into your monthly payment, or that PITI I mentioned earlier. Keep in mind that every mortgage payment includes 4 parts: principal, which is the money you actually borrowed; interest, or the cost of borrowing that money from the bank. In the early years, most of your payment goes toward interest. There also are taxes, including property taxes, which are collected by your lender and paid on your behalf. These can rise if your home value is reassessed. Lastly, there's insurance. This can include homeowners insurance and possibly PMI or private mortgage insurance, which is usually required if you put down less than 20%. FHA's mortgage insurance can last for the life of the loan, while conventional PMI eventually drops off. And in our next video, we'll break down exactly how mortgage insurance works and what it means for your payments. It's also important to know that PITI isn't always the only thing in your monthly housing budget. Depending on where you buy, you may also have homeowners association or HOA fees, which can range from under $100 to several $100s a month. If your home is in a flood zone or coastal area, you may be required to carry flood insurance or windstorm coverage, which is separate from standard homeowners insurance. And some buyers take on additional monthly costs like mortgage insurance riders or special assessments in condos. These aren't always obvious up front, so it's smart to ask about them early. Otherwise, you may end up with a payment higher than you expected. Step 5 is to explore loan programs for first-time buyers. As a first-time buyer, you have several loan programs available to you. This includes FHA, conventional, VA, and USDA. Let's briefly talk about each one. FHA stands for the Federal Housing Administration. FHA loans provide first-time homebuyers with low down payment options, flexible credit requirements, and a more accessible path to homeownership. The drawback? A lower down payment means a higher loan balance. Additionally, your mortgage insurance will last the length of the loan, adding even more to your costs. Conventional loans have stricter credit requirements and a higher down payment than FHA loans, but PMI eventually disappears. VA loans are intended for veterans and active duty military. They require zero down and have no PMI. The drawback? With a no down payment, your balance starts high, meaning your monthly payments will be higher. USDA loans are backed by the Department of Agriculture and are specifically for designated rural areas. No down payment is required, and you may qualify if you meet income and location rules. But just like VA loans, no down payment means a higher starting loan balance. As you can imagine, each option has its pros and cons. Your step here is to compare which program matches your credit, savings, and where you plan to buy. Step 6 is to prepare for closing costs. Your down payment isn't the only upfront cost. You'll also need to cover closing costs, which include lender fees, appraisal, title insurance, prepaid taxes and insurance, and your realtor's commission. Closing costs can run 2% to 5% or more of the home price. On a $300,000 home, that easily means another $6,000 to $15,000. But don't get discouraged. Sometimes sellers help cover these costs, but it's up to you to ask. Just to be on the safe side, you'll want to budget for the full cost so you're not surprised at the closing table. And step 7 is to get yourself ready to apply. Before you walk into a lender's office, you can take a few smart steps. First, check your credit report for errors. You can request a free credit report from all 3 bureaus once every 12 months. You'll want to make sure everything is accurate and give yourself time to dispute and resolve anything that's not quite right. You also want to focus on paying down your debts to lower your debt to income ratio. We'll get into the nitty-gritty in another video, but just know that your debt should only be a small fraction of what you take home each month. If you're not already, start saving more than the bare minimum so you still have a cushion after closing. As you've learned today, there's more that goes into buying a home than just your down payment, and you'll want to be able to put food on the table and pay your bills once you move into your new home. So start saving more now. Lastly, get pre-approved before you start house hunting so you know exactly what you can afford. One of the first questions your agent will ask you is if you've been pre-approved. Both agents and sellers know that buyers who have taken this step are not only serious about buying a home, but lenders have deemed them financially qualified to do so. A pre-approval letter from your lender will go a long way. I know that might have been a lot, so let's recap. Here are the steps every first-time buyer should know. Step number 1, understand what a mortgage really is. Step number 2, figure out your down payment. Step number 3, check and improve your credit score. Step number 4, know the 4 parts of your monthly payment, or PITI. Step number 5, explore loan programs designed for first-time homebuyers. Step number 6, budget for closing costs. And step number 7, get yourself ready before you apply. Follow these steps and you'll go into the process with confidence. And now that you've got the foundation, your next step is comparing loan options. In the next video, I'll break down FHA versus conventional loans, the pros, cons, and how to know which one might be better for you. So hit subscribe and I'll see you there.